What was the value you expected to uncover for your existing customers? What was the value you were going to present to these new customers in the acquisition? Don't forget that. Focus on it. Create the value that you intended. Stick to your plan. Focus on it. Communicate consistently. It's a frequent thing that doesn't happen perhaps sometimes in mergers and acquisitions. The deal's done, everybody celebrates, and kind of the next 5-6 months the two businesses sort of running alongside instead of being fully integrated. Communicate to customers, communicate to your staff, communicate not just today but tomorrow and next month and the month after, and give them the same message. Be clear about where you're going. Address cultural issues early. And in relation to critical decisions, don't duck out of them. There are difficult decisions to make in dealing with mergers and acquisitions. It can be difficult to negotiate, but don't duck out of it once you've bought the business. What were you planning to achieve? What did you need to do? If you can get 8 out of 10 of those decisions made and 80 out of 100 actions completed, you'll have done extremely well. Focus on that. I know that our keynote speaker will mention a 100-day plan, and that's a very interesting idea that is often used in integrating following an acquisition. But finally, of course, don't forget controls. And somehow then we're almost there, aren't we, in terms of our journey, because we've got growth, and that's what we wanted. But a word about timing. Yes, there is a timing issue in most markets. Let's just remember that. Trends, fashions, changes with the economy. And you won't be surprised, will you? I know I'm stating the obvious here, but just enjoy it for a moment. Pawnbrokers, their businesses grew by 15% in 2011. What a great place to be if you were growing in that sector. Terrific. But what's the growth trend in your sector? What are the emerging things that are happening? Have a think about that. But where are you selling? Yeah, we've had a pretty dismal London, haven't we, this year, in terms of the weather. The colours kind of come from the Union Jacks instead of the sunshine, really, hasn't it? And we've all enjoyed the Olympics. Terrific time. But maybe you're selling elsewhere. And Ralph mentioned in his introduction, it could be these fast-growing economies of Brazil, Russia, India and China. Interesting focus. There is good growth to have there. But there is growth outside of that. Now, Ralph mentioned the Middle East. There are other countries where the growth is very strong. Don't neglect them. The interesting thing from a UK economy perspective, apart from the good news of the growth today, and we should almost kind of give a round of applause in a minute, but great news. Let's enjoy that and take confidence from it. But the interesting thing is that actually what's happening to the UK economy as well is that for the first time we're exporting more than 50% to countries outside of Europe. That's good news. There are opportunities. It's not as difficult as you think. Where does that bring us? Well, maybe that brings us to kind of the final destination. But if you think this is sunset, let me just tell you again, it's not. It's sunrise. Now this is sunrise over Mandalay. And of course the journey doesn't really ever stop, does it? Because, as we said at the start, you're growing. The journey you take, check of where you are, you want to continue to grow, and there are always opportunities, and you can't stand still. So growth will continue. And we are indeed at a sunrise moment now. Thank you.
We'll now pass the baton over to Simon Massey, who's going to tell us how we can let the tax man help us grow our businesses.
Thanks, Ralph. As John alluded to, and stole a couple of my comments as well, there are a number of ways that HM Revenue and Customs and the government in the UK are trying to help the tax system help you grow your business and just make UK PLC a better place to be. So what I'm going to do in a reasonably short order today is skim over the top of a couple of good internal tax breaks, talk a bit about staff motivation, because they're probably the most important asset in most businesses, and then just some comments about structuring acquisitions and raising capital, which I think are pertinent to the other speakers. First one is research and development tax credits. Just it's a gift. In essence, it's for all businesses carrying on qualifying research and development. So it's not just stuff in a lab or overly technical things, it is all sorts of things, manufacturing processes and all sorts of other things. And effectively what this does is it gives you, for a small and medium-sized enterprise, which is broadly one with a turnover under 100 million euros, it gives a 225% deduction. So in this example here, if you've got £100,000 of expenditure going through your profit and loss account, you can put a further 125,000, therefore getting a total 225,000 deduction for corporation tax purposes in your profit and loss account, or for tax purposes. And there's no clawback at the end of the project. It's not like a government grant where there's a clawback or other tax allowances where they're time related. This is no clawback. So this is great. It's free money. If you want, you can surrender the losses for a tax refund, and effectively you surrender the losses and you get an 11% tax refund, which is a reasonably low rate. But for an early stage business, it actually can help it out and see it through its cash flow issues. We've seen this in real life a number of times, particularly IT businesses or other sort of fledgling businesses where they're designing and getting a product ready for market. They use the R&D tax credits, they surrender them for a tax refund, get that refund, and it provides them 3-4 months cash flow funding, which is absolutely great. It's not just for the guys in the white coats, that's the point. It's for all sorts of businesses. Technology, manufacturing, and as I say there, it's really the only revenue team that we're aware of that are actually tasked with giving money away. So as I say there, if they want to give it away, let's have it. The next thing is patents, patent box. This is coming in next year, and is a new tax regime where for the use or exploitation of qualifying patents in a company, profits generated therefrom can be taxed at 10%, which is compares to a 23% standard rate of corporation tax. So you're over halving your corporation tax rates on use of patents. Now I gather, this isn't in yet, it comes in next year, or next April, or it's phasing from next April. But I gather, for example, Bentley have used this. And they have patented a wing mirror for their latest model. And that wing mirror is then put on the new car. Because one part of that entire vehicle has a patent on it, a new patent on it, the whole thing could be subject to this 10% patent box tax credit. So that is fantastic once again, free money. You need to think about it if you've got patents and qualifying patents. If anyone's interested in this and wants to know a bit more, we're running a series of seminars to kind of drill down this. Our R&D and patent team, led by my colleague Andy England, are running a series of series of seminars on patent box and R&D, and I think there's some flyers either in your packs or outside. And there's 3 more. One's here in about 3 weeks' time in this room. The next thing people overlook is to make best use of the retained profits. Because you kind of forget, actually, that the UK has a really generous rate of corporation tax. At the moment it's 24, it's dropping in April to 23%, and the Chancellor's announced that he would like it to drop as low as 20%. 20% retained profits on corporation tax is in the pack as being the sort of lowest quartile of the sort of industrialised nations in the world. Certainly lower than most of Europe. There's a designer tax rate in Ireland that's lower, but it's a bit difficult to get hold of. And there are some designer tax rates in Switzerland, but once again quite difficult to get hold of. But for a whitelist country, 20% tax rate is really very good. And that's why a lot of global businesses are now moving back in. The issue really is actually getting money out of a company. It's not really what the rate of corporation tax is. And most of our clients, when they say they've got a corporation tax problem, it's not that they've got a problem with the corporation tax, it's that they don't want to pay the income tax and getting the money out of the business. So you've just got to think about all of the alternatives. You know, should you be paying pensions? If you're paying pensions, should you be doing them in the business or not in the business? Should you be paying a salary or paying a dividend? Generally, paying a dividend is a better tax answer than paying a salary, unless you're doing research and development, in which case paying a salary might be better. But you need to look at it in the round, you need to take specialist advice. I wonder where you get that from. If your strategy is to build your business and sell it, then more often than not, corporate finance advisors are able to negotiate a pound for pound adjustment to the sale price. So that if you have any retained cash in the business, and you can do without it as taking a salary, leave it in the business and then you pay tax 10% on that when you actually sell the business, because you get a pound for pound uplift in the sale price. So if you're near a sale, then leave the money in, and a lot of clients do that. Keep staff motivated. As I said, this is a bit of a potpourri, this presentation. Be careful to structure incentives right. Just need to work out who your audience is. If you've got a bunch of 20-year-olds working for you, what are they interested in? What motivates them? Do you think a pension motivates them, or a long-term share option? Probably not. I suspect it's beer vouchers. However, if you have a workforce that are more mature, more interested in long-term structure of the business, and you want to motivate them, then you consider the other options, shares, other incentives such as a pension scheme, such as car allowances and all sorts of other things like that. In all of these, we can help you structure it to be reasonably tax effective, and in some cases such as the share options, there are some really generous tax schemes out there where the employee pays tax at possibly 10%, but probably no more than 28%, which compares very favourably to tax and national insurance, and the company gets a corporation tax deduction at about 20% on the market value of the shares. So actually it's a win-win for everybody. Right, on acquisitions. So you go through your acquisition strategy and you're following John's advice and buying a business. What do? You buy the shares, or do you buy the assets? Well, it depends. It kind of depends on all sorts of things, such as the due diligence and such as the feel of the business. But I think the important thing just to bear in mind is there's a difference of opinion. Very often, the person selling, whether they're a company or an individual, will want to sell shares. If it's a company, they want to sell shares because substantial shareholding exemption probably means there's no tax at all on the sale of their shares. If they're an individual, they'll want to sell shares because they'll be paying tax at 10%. If you're buying, you will want to buy goodwill or intellectual property because you can put that in your company's balance sheet and then write it off over a period of 3 to 5 years and get corporation tax relief for the amortisation of the goodwill. There is the price differential between what you want to do and what somebody else wants to do, and you're opening yourself up for an interesting negotiation. All I'm going to do is talk about tax. I then let John and his colleagues go through the mess of trying to negotiate that one, depending on the aspect of where they are. As John said earlier on, John stole this slide earlier on, if you're borrowing money, you get tax relief for borrowing money. Just bear in mind that shareholders can loan money to a company as well, and they can charge commercial interest rates for doing so. It's probably mezzanine finance, which is the more risky end of the finance, so you could be looking at, 15-ish% as a commercial rate of interest. So actually you can get a pretty good return as a shareholder by lending money to the company. You don't get tax relief, by the way, if the loan is convertible to shares, or could be converted to shares. And there's no ability to get tax relief there, and that's often overlooked actually. Raising money, very generous tax exemptions around nowadays to allow you to raise money. For those eligible for enterprise investment scheme, seed enterprise investment scheme that John mentioned, or where it's venture capital trust funded, generally it needs to be a business carrying on a qualifying activity. And it's kind of any sort of business that isn't property biased, banking, accountancy, legal, that sort of thing. So overtly financial businesses don't qualify, but I did years ago manage to get a company that did the back office for a credit card business approved as an EIS business, for example. So there's a line there, there's a fine line there as to where you can come across. But a property developer wouldn't qualify, for example. The investor gets tax breaks up front, so at the moment under enterprise investment scheme it's 30%. Under seed enterprise investment scheme, which is for the micro businesses, the micro startups, it's 50% up front. So if you invest £100,000 under a seed intro investment scheme, you can set £50,000 against your income tax liability. In essence, if you are the business seeking investment, as I'm saying there at the bottom, because you know these guys are getting a tax break on the way in and a tax-free exit, you can probably offer them slightly less than they might otherwise be seeking to get, because you know they've got a better tax deal. So you don't give away as much, and everyone's winning on the tax break. It's a bit fiddly to get some of these through in terms of regulation and forms and that sort of thing you need to do under the revenue. Like anything, if you want a good tax break, you've actually got to work at it, but worthwhile for the investor. As I said there, no person can have more than 30%, 30% up front, that's it. After 3 years, sell it, no tax. Company can raise up to 5 million on this. So really, all I really wanted to say is, talk to us, try to use all available reliefs. There's loads of things out there that can help in the right circumstances. More often than not, the best way to work out how to structure the start of a business is to understand how you want to leave that business. Because when we know how you want to leave that business, it actually helps drive the way we structure the acquisition and the share incentives and all the other stuff on the way through. If you don't understand what your game plan is, then we can't help you at the outset in the best way. Get the basics right though, and then you won't pay away too much. That's me, thank you.
Next up is Jeremy Hall, our keynote speaker. As I mentioned at the beginning, Jeremy is a serial entrepreneur. He forged his reputation for growing organisations acquisitionally through the dot-com boom. Jeremy is going to give us his perspective on how to find synergies, uncover value, and grow your business by acquisition. So,
Thank you, Simon. I'm going to keep away from the technical side actually and just talk about a few stories. I'm actually going to start with a story, and this story goes back to June 1998. I was driving around the M25 on the way to Tunbridge Wells, and we were looking to acquire a company. And when I was actually in the car, I was in the car with my brother, a lawyer, my first thoughts were, well, who's the lunatic here? Who's mad? Is it me, the man that's got to endure long, long days of getting of work and the traffic jams of the M25, or is it the person that's selling the business to us for a very good price? Anyway, so we got down to Tunbridge Wells. We signed up the deal, and it's interesting because when I signed the deal, my only thought was how quickly can we recoup our investment. It wasn't about trying to grow this business to another level. It was simply how quick we get our cash. So as the owner of the business left, he handed over his keys, he left the room, and that's it, he went. He was extremely embarrassed. He sold himself out, and there he left a team of 5 people in the office, and they looked at me, and all 5 of these people didn't realise if they were going to have a job in the next 5 minutes or not. So I sat down there and I said to this nervous bunch of people that what we bought here is not a customer base of 1,000 companies and an ongoing annuity stream, but we've actually bought the people. And I think one of the most important things that I found in business is actually you've got to take on and build good people and have loyal teams. So as I looked around the office, the first thing that I noticed was the state of the place, and the tables had 3 legs, the IT system was out of the dark ages, the carpets had holes in, the offices were totally unloved, and it was hardly surprising the staff were nervous. They assumed we had come in to asset strip the business, make them more redundant. So the first thing we did there was we got that team of 5 people out there to start sorting the offices out. So one of them went out and organised to get the painter in, somebody else organised some double glazing, we put air conditioning in, new carpets, new furniture, and also a new IT system. So by the end of the first day, our team of nervous staff had actually realised they are working for a company that wants to grow and go places. And I think that's one of the key reasons why we, in this specific instance, were able to see a return on our money within 18 months. Now, The topic for this evening is growing a company to the next level, and we know there's a variety of lots of different ways we can actually do that. But today I'd just like to focus on the acquisitional side of growth, and really I'm just going to throw in a couple of examples of things I've seen and gone through over my years. So when I set up, I was 24 years old, I had a mobile phone, and off I went. It was a lifestyle company. I had absolutely no regard for growth whatsoever. So if somebody said to me, if somebody said, what is the next level, how do you want to grow your company, I have no clue whatsoever. And I think it's a schoolboy error, because one of the most important things we have to do if we wish to grow a company to the next level is to define what the next level is. So we actually stumbled upon our growth curve when an unemployed friend of mine said a couple of years later, can I replicate what you're doing in the north of the country? So we set up a regional office, and within a few years we replicated that again and again, and we had a number of offices around the company. So back in 1998, along comes a NASDAQ software company, and I'm the one now that's taking the check and leaving the office and leaving a lot of very nervous staff. So we sold out the business, and then we became part of a much larger NASDAQ software organisation, and their strategy was very clear. Their strategy was to go out and acquire other companies. And over the next 2 years, I probably learned the most powerful lesson I've ever learned in business, which is the quickest way to grow a company is via acquisition. And the second key lesson that I learned is you actually make the money from acquisition. You do not make the money from selling the business. Moving on from this experience, the NASDAQ then crashed, as all we know, and before I know it, I find myself buying back the business. And for the next few years, it was pretty horrendous. We were completely frozen out with loads of toxic debt around us. We had to earn the money to pay back the debt and pay the interest, and that was a tough time for us. And for the first time ever, I actually realised what it is like to grow a business with no cash. And I think there's a lot of business people out there today that are in this position. They've got a lovely business, but they can't do much with it. They can't grow it, or don't think they can grow it because they don't have the cash available. But I think you can still do a lot. And I think one of the most important things we have to do as business leaders and entrepreneurs and managers, etc., is to remain positive. The second key thing I'll suggest to anyone is if you can't grow your business because you don't have cash, why don't you take a look at it and just tidy it up? And I'm making reference here to some very basic things. For a very small investment, we could all repaint the offices, maybe put in some new furniture, maybe change the carpets out. You can actually spend some time looking at your systems and procedures. So there's a whole host of things we can do as business leaders, even if we're not growing the business. The other key thing is speak to your customers. I'm amazed nowadays how many people just do not communicate with their customers. We bought a company a number of years ago. The company was based down in Bath, and I went down to Bath to do the due diligence to have a look at this business. And I said, look, I need to have a look at your customer records. And he took me to a warehouse, and lurking in the corner of this warehouse was a number of filing cabinets. And this guy had put all his customer records in these filing cabinets in the warehouse. And to me, he had absolutely no respect for his clients whatsoever. And that resulted in us not paying a lot of money for the company. And the next thing is you must develop a plan. Whenever we entertain new projects, we entertain a new acquisition, or whatever we're going to do, setting up a new business, one of the key things we will do is to put a 100-day plan in place. Now this is not my idea, it's stolen actually from one of the dragons, from one of the eminent dragons on Dragon's Den, who would always put a 100-day plan in. And I think if we all just use that a little bit more, then we could actually see some great results. So moving on to building via acquisition, I often get asked, how do you buy a company? And the actual process is relatively simple and straightforward. Now, Menzies have deliberately asked me not to plug them, so I'm not going to. But one of the most important things you've got to do is to get the correct advice. And that means speaking to a lawyer who understands acquisitions, it means speaking to a firm of accountants and also the corporate finance the people. And to be fair, they've actually got a fairly simple job. Their job is to protect your investment. It is to save you money. It is to stop you wasting money. And every time I've used a firm of corporate finance advisors, one of the key things that I found is the cost of the advice has always been less than the extra return we've got from them. So please, I'd always suggest get good advice. Now I'd like to ask a couple of questions here, and I've got here 3 questions, and I've done this speech a few times now, and I never get above 2 questions. So firstly, question number 1, who actually keeps a record of all their competitors? Anyone in the audience? We've got somebody there? Okay, right, so next to no people in here. The question number 2 was how many people in this audience actually monitor the financial performance of their competitors? And we've got 1, yes, fantastic. Anyone else? No? Okay, I'm not even going to bother asking question number 3. But if you want to build via acquisition, one of the most important things you've got to do is visit your competition. You've got to work out who they are, pick up the phone, go and see them, and start, building relationships there. We talk about acquisition, and I talk about competition, but it also could be maybe a key supplier or another sort of organisation you're looking at. Another statement that I hear all the time when I'm having a conversation about building a company or growing a company by acquisition, it is this famous line, "I cannot afford it." And I've got numerous cases where you can actually afford it. One of the big acquisitions we did, we bought one of the UK's oldest and most established leasing brokers in the UK. We paid a small sum of money up front, and then what we did, we paid an amount of money every month for the next 2 years. And the profits of that business, in effect, paid for the acquisition. Another example is we went to a company and we bought their customer base. It was 100 companies, and the reason for buying these companies is there is an annuity stream attached to it. And what we did, again, is we paid a small amount of money up front, and then once we actually made enough profit to cover that, we then decided to split the profits 50-50 with them going forward. So in effect, we were able to take on a lovely customer base for not a lot of money. Now, one of my favourite stories was when we bought a division of a recruitment and a training company a number of years ago. And the story goes that the gentleman who was selling this division said to me, "Are you interested in buying it?" So we had a look at it, we ran the numbers, and the investment was just too rich for us. We could not afford this investment. It was just a little bit of a risk too far. So I went back to him and I said, "Look, love to buy it, but we cannot afford to do the deal." And he sat there and said, "Well, make me an offer." And I didn't want to make him an offer because I thought that would insult him. But anyway, regardless, I did insult him by making him an offer. And he came back to me, and what he said was, he didn't say no. He said to me, "Okay, I accept your offer, but we have got to do the deal tomorrow." Now, the first thing I thought was, what's the hole that's here? What don't I understand about this acquisition? Am I missing something? But anyway, the next day, sure enough, I turned up in his offices, we had the cheque, we had the sale and purchase agreement, and we did the deal. We shook hands, and I walked out of his office, and I went down the stairs and round the corner, and I then phoned my business partner to say, "Right, deal's done, we've got the customer base, and off we go." And there, the guy that just bought the company, just sold the company to me, he comes walking round the corner, sees me, and he had the cheque in his hands. And he said to me, quote unquote, he says, "I'm just off to the bank, I hope the cheque doesn't bounce." And anyway, it didn't bounce, you'd be pleased to know. But a few months later, or 6 months later, whatever the timescale was, we went out to lunch together, and I said to him, please explain to me, why did you sell that division? Because, we got a good deal there. And he says, "Jeremy, I was taking your cheque to the bank. If your cheque had not gone into the bank, and if your cheque had not cleared, I would have been out of business." So the point is you'll be amazed at the deals you can do out there. And I think when somebody says to me, "You can't afford it," often you can. When we're doing an acquisition, regardless whether it's a company or a customer base, one of the most important things you have got to do is to discover the truth of why they are selling. And I'd just like to give a couple of personal examples. One of my core businesses was a leasing company called Wise Leasing, and in 2009 we sold this business to a German bank. It was the height of the recession. The value they were giving us was very, very good. And to be honest, the strategic fit with what they were looking to do didn't make sense. But anyway, regardless, we sold the business, and it was a period of time later, only then, that we found out the real reason why they bought the business. Now, the UK division of this German bank that bought the company had to present their yearly figures at this year start meeting for all the European counterparts. And we worked out that the actual profit that they had made themselves was hardly anything. So if you took their profit and our profit and you amortised the acquisitional costs over 10 years, we actually saved their face. So if that deal hadn't gone ahead, they would have been just highly embarrassed in front of their European counterparts. So they had a very simple reason for buying the business. Another example was another leasing company we bought many years ago. The price we paid for the business was equivalent to 1 year's profits. It was a very good deal. We bought the business with a fairly substantial overdraft already in place. Our covenant was better than the original covenant, so the bank was happy to transfer the overdraft facility. And again, you know, we didn't really understand the true reasons why he was selling. He later told us, and it later became apparent, that the key reason why he sold the business was the bank was going to pull the plug on his overdraft. He had no choice other than to sell the business. So the key thing is if you are in this zone of buying customer bases, buying companies, or anything like that, you must dig deep. You must find the truth. Ultimately, you'll save the money. Whenever I do an acquisition, I always look for that little pot of gold in the corner. And I think that nearly every company I go and visit has a pot of gold. It has some form of asset that I can see that other people can't see. Now, often that asset is very simple. Simply, it might be customers, it might be a supplier, it could be staff, or whatever. We bought a one-man business. The company's called AKA. We worked with the same supplier. He did 20% of the volume of business we did with this supplier. So we worked out this acquisition would pay for itself in, I think it's 18 months, whatever. And we worked out that we'd go back to the supplier with the combined business we're going to do. What we didn't realise was that this supplier, even though he was doing 20% of the amount of business we were with the supplier, his buying rates were better than ours. So his cost of stock or whatever was cheaper. So we went back to that supplier, and that acquisition paid for itself within a period of 3 months, because we were able to get a better deal from that supplier with the enlarged business. Finally, we got the benefits of asset stripping. I'm not going to go into that, because I think we will understand what that is. For me, one of the key challenges we have as a business nowadays is finding good quality people and good quality management. And for me, that's probably one of the key reasons why I would look to acquire, especially if I'm looking to grow regionally, is to find the good quality people. We just did some analysis recently, and the analysis was we modelled the cost of taking on a new external salesperson. So this is a gentleman or a lady who would go externally and visit, customers. And it takes 6 months for somebody to break even in our industry, and at the 6 months period, it is an investment to us of £20,000. So if we have a team of 5 salespeople, we could be in for a £100,000 investment. So often you'll find it is cheaper to go and buy a business than actually to train up and take on work with new people. The same with customers. It's a recognised fact. Often the cost of bringing in a new customer is typically 5 times the cost of working with an existing customer. You've got the benefits of entering new markets, of developing new products. I'm just going to use a quick example here. Back in about the year 2000, we realised that the asset recycling market was going to be huge. The WE directive was coming into place, which means that you can't just throw your old computer in a bin. So we looked at this asset recycling business and very quickly realised that you need to have waste carriers licences, toxic licences, ISO 9000. I mean, we could have spent a fortune with Menzies just giving us all this advice on what licences you have to have. But what we worked out was it was a lot quicker, a lot cleaner, and a lot simpler to actually go and buy the asset recycling company, which we actually did. Lastly, again, I've got reducing costs. Again, it's pretty obvious. You merge 2 businesses together, you reduce the costs. So I started off talking about ITR. I think we have a duty of care to the country and as businessmen, as people who run businesses or own business, whatever, to look after our business, to grow them and develop them. Our businesses are a living, breathing entity, and I'm confident that if we do not look after our company and look after our staff and try and grow the business, all that happens is we will go backwards. For me, acquisitions are fun, they're exciting, they're rewarding. I'm quite vocal on the subject because I love it, and I find that, you know, it's just over the years I've worked many, many years trying to organically grow a company. It's just so much easier to go out and to buy one. But my final bit is obtain advice, and I don't profess to know half the things that Simon or John talked about here. Quite frankly, I don't need to know the detail of it. All I need to know is that if I'm going to do an acquisition of a certain size, that we must get good advice from people who actually understand what they're on about. So thank you very much.